Hello and welcome to my channel all about accountancy, where we convert your accounting problems into solutions. I am your host Professor Tanmaypvttutor, and today I am back with the third episode of What Do You Mean? What Do You Mean is a series in which I discuss some of the accounting terminologies which a layman should understand before learning accountancy. Today's video is all about asset, liability and capital. So, what do you mean by an asset? An asset is any property which is owned and used by the business in order to run the business. Any amount receivable in the future or any expense which is paid in advance can also be termed as an asset of the business. Asset can be further divided into three parts: fixed assets, current assets and fictitious assets. Fixed assets are assets which are held for a longer period of time. Normally these assets are held for more than a year. So assets like land, building, machinery, furniture can be termed as fixed assets. Fixed assets are sold only when they become obsolete, that is outdated, or when they are completely worn out. Fixed assets can be further divided into tangible assets and intangible assets. Tangible assets are those which we can touch and see, such as building, furniture, machinery, etc. Whereas intangible assets are those which you cannot touch and see. They do not have a physical form, but they have a monetary value. Assets such as goodwill, copyright, trademark, patents are intangible assets. Moving on to current assets. Current assets are assets which are held for a short-term period. Any assets which are held for a period less than a year can be called as current assets. Current assets are assets which can be easily converted into cash. Current assets include cash in hand, cash at bank, stock, etc. As I had mentioned earlier, any amount which is receivable in the future can also be termed as an asset. Mostly this amount is to be received within a year, hence such amounts are termed as current assets. They include debtors and bills receivable. Also, any expense which is paid in advance, such as prepaid expenses, are also included in current assets. Moving on to fictitious assets. Fictitious assets are intangible assets which do not have a physical form but have a monetary value. Fictitious assets are expenses or losses which are to be paid by the business organization in the future. Preliminary expenses, underwriting commission, share issue expenses, etc. are some of the examples of fictitious assets. Fictitious assets do not give you anything in return, whereas current assets and fixed assets give you something in return at the end of their lives. Now moving to the next topic, that is liability. What do you mean by a liability? Any amount which is payable by the business organization to the outsiders is a liability for the business. Now don't get confused over here. Any amount which is paid is your expenditure, but any amount which you are going to pay in the future is your liability. Liability can be further divided into fixed liability, current liability and contingent liability. Fixed liability is a long-term liability. Any amount which is payable in the long run is your fixed liability. To be specific, fixed liabilities are liabilities which are payable for more than a year. So any loan which is payable after a period of 1 year is your fixed liability. Moving on to current liability. Current liabilities are liabilities which are payable in the short run. Such liabilities are payable within a year. So it includes any amount which is payable to our suppliers, that are known as creditors, bank overdraft, bills payable, outstanding expenses, etc. And the last type of liability is contingent liability. Contingent liability is a liability which may or may not be payable on the occurrence or non-occurrence of an event. It includes any claims which are done on the business organization. If the claim realizes, then we are supposed to pay that liability, but if the claim does not realize, we are not supposed to pay this liability. As this liability is not fixed or its existence is not fixed, we never record this liability into the books of accounts, but we mention it as a footnote into the books of accounts. So if that event actually happens, only then we will record this liability into the books of accounts. Otherwise, it will be cancelled from the books of accounts. And now moving to the last topic, that is capital. What do you mean by capital? Any asset or liability brought in by the owner in order to start and run the business is the capital of the business. Capital is a liability for the business because it is the owner's contribution and the business has to pay it in the future. Capital is the excess of assets over liabilities, and it can be expressed as capital is equals to assets minus liabilities. To conclude, I would say that no business is possible without an asset, a liability, and capital. I hope you have understood today's concept. If you have, then please like my video, share it, subscribe to my channel, and hit the notification bell so that you never miss a video. I upload videos every Wednesday and Sunday. If you have any doubts or suggestions, you can use the comment box down below. See you in my next video. Till then, this is Professor Tanmay Kesarkar signing off. Good luck and take care.